Section number 4. Interaction with the external auditor. The Audit Committee plays a critical role in the appointment of the external auditor. In terms of Section 94, the Audit Committee's duties include nominating an auditor for appointment that in their opinion is independent. Whether shareholders appoint an auditor other than the auditor nominated by the Audit Committee, the Audit Committee must be satisfied with the independence of the appointed auditor. Accordingly, where the independence of the auditor has not been ratified by a properly constituted Audit Committee, the auditor's appointment may be invalid. Audit committees of companies are responsible for the appointment, compensation, and oversight of the external auditor, including the resolution of any disagreements with management. It is paramount that the Audit Committee, management, the internal auditors, and the external auditor work together in a spirit of mutual respect and cooperation. The active involvement of a high-quality, transparent Audit Committee will enhance the perception of the audit quality and of the quality of the financial statements. Leading practices for the Audit Committee's relationship with the external auditor include: exercise ownership of the relationship with the external auditor. Discuss with the auditor any potential or contentious issues in terms of independence/ethical requirements. Get to know the lead partners and meet periodically with specialists, for example tax, IT, fair value. Establish expectations regarding the nature and method of communication, as well as the exchange of insights. Engage in consistent dialogue outside of the regularly scheduled meetings. Set an annual agenda with the external auditor. Focus on independence, including a process for the pre-approval of services beyond the audit. Provide formal evaluations and regular feedback. Private sessions with the external auditor are a way to maintain open communication and identify concerns. The Audit Committee and the external auditor typically meet at least quarterly and engage in thorough discussion. The Audit Committee should have a process for overseeing management's resolution of significant issues raised by the external auditor. Communication between the Audit Committee and the external auditor. The external auditor is required by the International Standards on Auditing to communicate the following to the Audit Committee. The auditor's responsibilities in relation to the audit. This may include an understanding of the terms of the audit engagement, normally outlined annually in an engagement letter, including the objective of the audit and the responsibilities of the auditor and management. The form, timing and expected general content of communications with the Audit Committee. An overview of the planned scope and timing of the audit. This may include the nature and extent of specialized skills necessary to perform planned audit procedures. The extent to which the external auditor plans to rely on work performed by the company's internal audit function or others in the audit of the financial statements and internal control over financial reporting. The names, locations, and anticipated responsibilities of any firm or personnel performing audit work in the current period but not employed by the auditor. The auditor's rationale for serving as principal auditor if significant parts of the work are performed by others, and any significant changes to the original strategy or significant risks and the reasons for such changes. Fraud or information that indicates that fraud may exist or other matters relating to fraud relevant to the responsibilities of the Audit Committee. Suspected or actual non-compliance with laws and regulations. Significant findings from the audit, and the auditor's views about significant qualitative aspects of the entity's accounting practices, including accounting policies, accounting estimates and financial statement disclosures. Matters to be discussed include management's initial selection of, or changes in, significant accounting policies or the application of such policies in the current period, and the effect on financial statements or disclosures of significant accounting policies in controversial areas or areas for which there is a lack of authoritative guidance or consensus, or diversity in practice. All critical accounting policies and practices to be used, including the reasons certain policies and practices are considered critical, and how current and anticipated events might affect the determination of whether certain policies and practices are considered critical. When applicable, an explanation of why the auditor considers a significant accounting practice that is acceptable under the applicable financial reporting framework not to be most appropriate to the particular circumstances of the entity. Critical accounting estimates, including a description of the process management used to develop critical accounting estimates, management's significant assumptions used in critical accounting estimates that have a high degree of subjectivity, any significant changes management made to the processes used to develop critical accounting estimates or significant assumptions, a description of management's reasons for the changes, and the effects of the changes on the financial statements. Significant unusual transactions, including significant transactions that are outside the normal course of business for the company or that otherwise appear to be unusual due to their timing, size or nature, and the policies and practices management used to account for significant unusual transactions. Significant matters arising during the audit in connection with related parties. Material misstatements of fact contained in other information. The auditor may also communicate their responsibility, including any related procedures performed and the results of such procedures when other information is presented in documents containing audited financial statements. Events or conditions which cast significant doubt on the entity's ability to continue as a going concern. The communication may include the auditor's conclusion about management's plans to alleviate substantial doubt about the company's ability to continue as a going concern and the effects, if any, on the financial statements and the auditor's report, if substantial doubt remains about the company's ability to continue as a going concern. Uncorrected misstatements and the effect that they may have on the opinion in the auditor's report and the effect of uncorrected misstatements related to prior periods, including those where there was another predecessor auditor, on the relevant classes of transactions, account balances or disclosures, and the financial statements as a whole. Other matters communicated or discussed with management. Written representations the auditor is requesting. Possible modifications to the auditor's report, i.e. a modified opinion or an emphasis of matter or other matter paragraph, including the reasons for modifying the opinion and the proposed wording to be used in the auditor's report. Any significant difficulties encountered during the audit, including, but not limited to, significant delays by management, the unavailability of company personnel, or an unwillingness by management to provide information needed for the auditor to perform his or her audit procedures, an unreasonably brief time within which to complete the audit, unexpected extensive effort required by the auditor to obtain sufficient appropriate audit evidence, unreasonable management restrictions encountered by the auditor on the conduct of the audit, and management's unwillingness to make or extend its assessment of the company's ability to continue as a going concern when requested by the auditor. Significant deficiencies in internal control identified during the audit, including a description of the deficiencies and an explanation of their potential effects. This would also include significant deficiencies identified by component auditors. Group audit matters, i.e. scope of the audit, involvement in the component auditor's work, limitations on the scope of the work, fraud-related matters. Failures by group management to inform component management of matters significant to the financial statements of the component. Matters relating to subsequent events, i.e. facts discovered after the date of the auditor's report but before the financial statements are issued that would have impacted the auditor's report or are discovered after the financial statements have been issued. Other matters arising from the audit that are significant to the oversight of the company's financial reporting process, including complaints or concerns regarding accounting or auditing matters that have come to the auditor's attention during the audit, and the results of the auditor's procedures regarding such matters. Certain matters relating to the auditor's independence. In addition, the external auditor generally communicates the following to the audit committee. Key audit matters. Whether the audit committee is aware of matters relevant to the audit, including, but not limited to, violations of laws or regulations. Matters that are difficult or contentious for which the auditor consulted outside the engagement team and that the auditor reasonably determined are relevant to the audit committee's oversight of the financial reporting process. Management's consultation with other accountants about significant auditing or accounting matters when the auditor has identified a concern regarding such matters. Any disagreements with management about matters, whether or not satisfactorily resolved, that individually or in the aggregate could be significant to the company's financial statements or the auditor's report. Appointment of the external auditor. All companies that are subject to a mandatory audit must appoint a registered, in terms of the Auditing Professions Act, independent auditor at every annual general meeting. This requirement will also apply to those companies that voluntarily elected to comply, and provided for such requirement in their Memorandum of Incorporation. The Audit Committee must nominate an auditor, which it regards as independent from the company, see above, to the shareholders for appointment. Where the shareholders elect to appoint a different auditor, the appointment will only be valid if the Audit Committee has verified that the auditor is independent. Where a firm is appointed as auditor, the Audit Committee must also verify the independence of the individual that will be responsible for the audit, the designated auditor. The name of the designated auditor must be included in the register. Audit Committee to communicate with the external auditor. Meet to review and discuss with the external auditor the company's annual audited financial statements and interim financial statements, including disclosures in management's discussion and analysis. Periodically, meet separately with the external auditor, management, and the internal auditors. Obtain a formal written communication from the external auditor regarding independence and other matters annually. Review with the external auditor any audit problems or difficulties and management's response. Set clear hiring policies for employees or former employees of the company's external auditor. Auditor independence. Independence is governed primarily by the requirements of Section 290 of the International Ethics Standards Board for Accountants, ISBA, Code of Ethics for Professional Accountants, the IFAC Code. Furthermore, auditors are required to comply with the Independent Regulatory Board for Auditors, IRBA, Code of Professional Conduct for Registered Auditors, which is similar to the IFAC Code. The independence rules are different for entities governed by the Securities Exchange Commission, SEC. For such entities, the SEC rules should be studied on what is applicable. For the purpose of this section, we will focus on the independence principles per the IFAC Code. The independence rules address the following issues. Relationships between the auditor and its audit client arising from personal financial interests, family and personal relationships, employment relationships, business relationships with audit clients and consultants, non-assurance services provided by auditors, contingent fees and commissions, long association of senior personnel with the audit client, which incorporates partner rotation, the Audit Committee's administration of the audit engagement, compensation of audit partners, financial interests. Holding a financial interest in an audit client may create a threat to independence depending on the a. role of the person, b. whether the holding is direct or indirect, and c. the materiality of the financial interest. Examples of such threats can include investment in the audit client's debt or equity securities, loans, collective investment funds and other financial interest products or financial interests held by trusts or estates of which certain of its people, and/or their immediate family members, are trustees or executors. In some audit firms, the rules regarding investments in audit clients can be more restrictive than the IFAC rules, and the Audit Committee should inquire from the auditor if they have more restrictive policies on financial interest. Family and personal relationships. Threats to independence occur when family and personal relationships exist between the audit team and a director or officer or certain employees, depending on their role, of the audit client. Depending on the closeness of the relationship, safeguards could reduce the threat to an acceptable level. Otherwise, the individual who has such a relationship shall not be a member of the audit team. Employment relationships. The rule states that independence is impaired if a current partner, principal, shareholder, or professional employee of the external auditor has an employment relationship with, or serves as a member of the board of directors or similar management or governing body of, the audit client. Independence can be impaired if former partners or members of the audit engagement team are employed as directors or officers or employees in positions to exert significant influence over the preparation of the audit client's accounting records of the financial statements on which the audit firm express an opinion on. Such individuals should not be employed by the audit client unless certain criteria are met, such as the position offered to the person, the former role of the person as the audit client, continuous involvement at the audit client, and the time that has passed from last audit prior to the position being filled. Partners of the audit firm should not act temporarily as a director, officer or employee of an audit client. Seconding of professional staff to an audit client for a short period of time may in certain instances be provided. The temporary secondment of staff is not allowed for audit clients that are SEC registrants or affiliates of SEC registrants. Business relationships. The rule prohibits an external auditor from having a direct or material indirect business relationship with an audit client, or with persons associated with the audit client in a decision-making capacity, such as an audit client's officers, directors, or substantial stockholders. This prohibition does not preclude the external auditor from providing permissible services to the audit client or purchasing goods or services from the audit client as a consumer in the ordinary course of business. There are rules for different types of business relationships between the audit firm and the audit client or its personnel that should be considered. For example, vendor business relationships, marketplace business relationships, including alliances, teaming, prime/subcontracting, reseller, investment, commission or referral fee, sponsorships, co-publishing and speaking engagements. Non-assurance services provided by auditors. Providing non-audit services to the audit client may create threats to independence. The rules permit an auditor to provide certain non-audit services, and in other cases it may be possible to eliminate or reduce the threats created by the application of safeguards. Non-audit services are required to be pre-approved by the Audit Committee. The auditor should never take up a management responsibility when providing any permissible non-audit services to the audit client. The independence rules include certain prohibitions on the following list of services depending if the non-audit services is being provided to the audit client, or any of its subsidiaries, affiliates or divisions. Some of the non-audit services are completely prohibited for public interest entities. List of non-audit services with specific independence rules to be considered include: tax services as follows: tax return preparation services, tax calculations for purpose of preparing the accounting entries, tax planning, and other tax advisory services, assistance in resolution of tax disputes, design and implementation of financial information systems, appraisal or valuation services, fairness opinions, or contribution in kind reports, actuarial services. Cognizance should be taken of the provisions of Section 92 and 3 of the Companies Act, in which requirements for the appointment of the auditor are set out. Both the person responsible for the audit as well as the audit firm are prohibited from providing accounting, bookkeeping and related secretarial services on a regular or habitual basis, and may not engage for more than 1 year in the maintenance of any of the company's financial records or the preparation of any of its financial statements. Where such services were provided at any time in the 5 years preceding the appointment of the auditor, such auditor or audit firm will be disqualified from appointment. As such, the Audit Committee needs to request the auditor and management to provide detail with respect to the non-audit services provided by the auditor prior to appointment, and specifically consider whether or not the auditor, or any other member of the audit firm, provided any of the prohibited services, bookkeeping, accounting, related secretarial services, maintenance of financial records or preparation of the financial statements, to the company in the preceding 5 years. Auditor rotation. The Companies Act provides for the regular rotation of auditors. The designated auditor, not the firm, must be rotated every 5 years. The same individual, designated auditor, may not serve as the auditor or designated auditor of a company for more than 5 consecutive financial years. In terms of the provisions of the Act, an audit partner will be disqualified from serving as designated auditor as soon as he or she had served as designated auditor for more than 5 years. Where an individual has served as the auditor or designated auditor of a company for 2 or more consecutive financial years and then ceases to be the auditor or designated auditor, the individual may not be appointed again as the auditor or designated auditor of that company until after the expiry of at least 2 further financial years, cooling off period. The IRBA introduced mandatory audit firm rotation effective from the 1st of April 2023. In terms of this regulation, the audit firm may not accept the appointment as auditor if that firm has served as the auditor of that company for more than 10 consecutive financial years on or after the 1st of April 2023. The audit firm will only be eligible for appointment as auditor after a cooling-off period of 5 years. Quality of the audit. The Audit Committee can positively influence the quality of the audit through actively engaging with the auditor and questioning the auditor where there is concern that the audit quality is inappropriate. The motivation of the audit committee should not be on minimizing costs, since this may impact audit quality, but rather focusing on ensuring that sufficient, appropriate resources, including experts, have been involved on the audit and risks adequately addressed. The Audit Committee should consider evaluating audit quality and defining criteria for measuring the quality of the audit. Evaluation of the external auditor. Because there is no formal guidance regarding the evaluation of the external auditor and because needs and preferences vary by company and audit committee, practices for evaluating the external auditor range from highly formalized processes with extensive documentation to more informal processes. Factors the audit committee may consider in developing an evaluation process include frequency and timing of the evaluation. Many audit committees perform the evaluation annually, immediately following the fiscal year financial reporting. Parties involved in the assessment. Although Section 94 of the Companies Act does not require the audit committee to evaluate the external auditor, many conduct some form of evaluation to make decisions on auditor appointment and retention. As noted previously, Section 94 of the Act established the Audit Committee's responsibility for the appointment, compensation, and oversight of the external auditor. However, it may not be practical for the Audit Committee to oversee and coordinate the entire evaluation. In many instances, the Audit Committee delegates the coordination responsibility to the Internal Audit Department or another group in the company. The party responsible for coordinating the evaluation should obtain information not only from the Audit Committee, but from senior financial management and the internal auditors. Depending on the size and structure of the company, it may be appropriate to obtain input from the management of significant operating locations or business units. Form and nature of the assessment. Some external auditors have assessment questionnaires for evaluating client service. Audit committees can use these questionnaires, tailor them to fit their needs, or create their own. The assessment can be done by having the relevant parties complete the questionnaire in writing or by holding interviews. They may also have a discussion about the experience the Audit Committee and others at the company have had in working with the external auditors. Assessment criteria. The criteria for evaluating the external auditor vary. Common criteria specific to the engagement team include technical competence, industry knowledge, frequency and quality of communication, cohesiveness as a team, and the level of support provided to the Audit Committee in fulfilling its responsibilities. Audit committees may consider information about the characteristics of the audit firm itself, such as size, financial strength and stability, presence in key markets, approach to professional development, technological capabilities, nature of the audit approach, quality of thought leadership, and eminence in the marketplace.